The U.S. stock market is currently closed right now on Monday, July 6, 2026 at 12:31 p.m. IST. The latest closing price for Lucid Group Inc., trading under the ticker LCID on the Nasdaq, was recorded at $6.08 per share at the close of the regular trading session on Thursday, July 2, 2026 at 4 p.m. Eastern Time. This closing figure followed a prolonged holiday period where markets remained closed on Friday, July 3, 2026 for the Independence Day holiday observance. During that final active session, the stock experienced a dramatic downward intraday movement of 19.22%, plunging from its previous close of $6.63. The stock saw high volatility throughout the session, hitting an intraday high of $6.91 before intense selling pressure dragged it down to a low of $5.96, close to where it ultimately finished before the long weekend. The core reality that many retail market participants miss is that while retail buyers look at this steep drop as a temporary bump on the road to a luxury electric vehicle takeover, institutional options desks are aggressively pricing in structural capital degradation that could permanently alter the capital structure of this company. The typical retail investor using a standard individual brokerage or checking regular investing sites looks at Lucid and sees a company with unmatched battery efficiency, sleek premium designs, and the financial backing of the Saudi Arabian Public Investment Fund. The expectation is that because the vehicles boast superior range figures compared to Tesla stock, it is only a matter of time before the brand captures the premium luxury tier of the automotive world. The underlying reality is far less comforting. The market is discovering that technological superiority does not automatically translate into a viable manufacturing business model, and the massive cash burn required to sustain operations is diluting public shareholders at a rapid pace. This tension between engineering achievements and financial sustainability is what is currently driving massive trading volumes across retail apps like the Robinhood app and traditional platforms like the Fidelity mobile app. When you look at the recent trading volume, which reached over 14.37 million shares in the last full session against an average daily volume of roughly 16.16 million shares, you can see a tug-of-war playing out in real time. Institutional players are using advanced order routing through the Interactive Brokers platform to hedge their positions, while short interest remains a massive variable, keeping the stock highly sensitive to macro pressures. Retail investors managing their own portfolios through self-investing models often find themselves caught in these rapid shifts. Traders utilizing SoFi Active Investing or looking for investment help on various digital message boards frequently mistake short-term short-covering rallies for a fundamental shift in the company's financial health. For instance, the stock recently saw an aggressive upward move from its 52-week low of $4.47 up toward the high $6 range, giving retail observers the impression that a major turnaround was underway, only for the subsequent session to erase nearly a fifth of the stock's total value in a single afternoon. This structural volatility is intensified by broader macroeconomic developments affecting the entire automotive sector. Rising financing costs, sticky inflation, and shifting consumer preferences away from high-priced luxury electric models have compressed the addressable market for premium vehicles. Investors tracking the sector through broader vehicles like Fidelity ETFs or selecting individual equities via the Robinhood stock trading interface are witnessing a systemic re-rating of speculative electric vehicle companies. While mega-cap technology firms like Apple stock or Nvidia stock have consistently absorbed institutional liquidity due to their robust cash flows and share buyback programs, speculative industrial firms without positive free cash flow are experiencing severe liquidity drains. The broader market environment has shifted from rewarding long-term growth potential to demanding immediate fiscal discipline and path to profitability clarity, a metric where Lucid continuously struggles to satisfy analysts. To fully understand why the stock behaves this way, we have to look closely at what this business actually does and how its operational model is constructed. Lucid Group Inc. operates as a vertically integrated electric vehicle manufacturer focusing specifically on the high-end luxury market. Their flagship vehicle, the Lucid Air, is built around proprietary powertrain technology that delivers exceptional miles per kilowatt hour, outperforming almost every competitor currently on the road. The company handles its own battery pack design, electric motor manufacturing, and software integration at its production facility in Arizona, alongside an emerging assembly presence in Saudi Arabia. In their older financial reports and past performance cycles, the company repeatedly pointed to this engineering edge as their primary moat, arguing that superior range would command a premium price tag capable of offsetting their initial capital expenditures. However, the historical financial data paints a challenging picture of the automotive assembly business. Building vehicles is an incredibly capital-intensive endeavor that requires massive scale to reach positive gross margins. According to recent quarterly filings, the company's cost of goods sold has consistently exceeded its total revenue by hundreds of millions of dollars each quarter. For example, in the first quarter of 2026, the company generated roughly $282.46 million in revenue, but faced a cost of revenue near $594.17 million, resulting in a severe gross loss before even accounting for research and development or corporate overhead. When you add over $335 million in research and development, alongside more than $304 million in selling, general, and administrative expenses, the total operating loss for a single 3-month period regularly approaches the $1 billion mark. This means that for every vehicle delivered to a customer, the company is effectively losing a significant amount of capital on a fully loaded cost basis. This persistent imbalance explains why the company is constantly dependent on fresh capital injections to maintain its liquidity cushion. While automated systems like Schwab Intelligent Portfolios or an intelligent portfolio algorithm might look at the company's cash balance and see billions of dollars in reserves, an investor performing independent online investment analysis will note that a huge portion of that capital arrives via equity dilution or debt issuance, rather than vehicle sales. The Saudi Public Investment Fund has repeatedly stepped in to purchase billions of dollars in newly issued shares or convertible debt, keeping the lights on but continuously expanding the total share count. This continuous dilution acts as a heavy anchor on the per-share value, meaning that even if the enterprise value of the company grows, individual brokerage account holders see their slice of the pie get smaller over time. Please take a moment to comment below how many shares of Lucid Group Inc. you currently hold in your portfolio, and let me know if you are buying this recent dip or staying away entirely. Looking at the future outlook, the primary catalyst that the market is watching is the upcoming deployment of their new premium sport utility vehicle, the Gravity. The expectation built into the current valuation is that entering the highly lucrative crossover and SUV market could unlock a completely new demographic of buyers who were previously uninterested in a traditional luxury sedan. If the company can successfully ramp up production of this new model without catastrophic manufacturing delays, it could significantly boost their delivery numbers and improve factory utilization rates, which is the fastest way to turn gross margins positive. Retail platforms offering fractional shares like Robinhood Investments or those using specialized Fidelity mutual funds with automotive exposure are watching these production metrics closely as the defining factor for the second half of the year. However, the reality is that launching a brand new vehicle platform introduces massive execution risks. Supply chain bottlenecks, battery cell sourcing constraints, and production ramp-up costs frequently result in initial build quality issues and delayed timelines. Furthermore, the luxury SUV space is no longer an uncontested playground. Legacy premium brands are introducing highly competitive electric options, and dominant players are constantly adjusting their pricing strategies to maintain market share. If the company is forced to engage in a prolonged price war to move inventory, their projected revenue per vehicle will drop, deferring their timeline for achieving positive cash flow even further into the future. For self-directed investors browsing through investing sites or managing retirement accounts via Fidelity IRAs, this execution risk requires careful monitoring of production guidance versus actual delivery data. Another critical scenario to consider is the strategic relationship with their majority shareholder. The Saudi Sovereign Wealth Fund holds an immense stake in the business, which provides a level of downside protection that other struggling electric vehicle startups simply do not have. This backing prevents the company from facing immediate insolvency risks, a factor that keeps the stock